Okay, we are ready to start the market making panel. So I will let all the guests introduce themselves. I'm going to take a seat. So little introduction. As beyond being ETHMilan co-founder, I am also the general manager of Trader Joe, decentralized exchange on Avalanche, Arbitrum, and BNB. As a decentralized exchange, we have had a lot of experience with on-chain liquidity and, of course, market making, which has different level of meanings when it's on-chain versus off-chain. And I will let the other speakers of the panel introduce themselves now.
Hi everyone, my name is Gaia De Ponti. I work for GSR. We're one of the oldest market makers in the space, and we've been around for about 10 years. I've been with GSR for 2.5, and I'm in the business development team. My background is in traditional finance, so lots of cross-applicable topics here.
Hi everyone, I'm Ioannis, and I work on the business development and growth side at Hercle. For those of you that are not familiar with what Hercle is, in a nutshell, we are a market maker and broker-dealer for digital assets, licensed as a virtual asset service provider and operating actually out of here in Milan, Italy. More specifically, we run a high-frequency trading and market-making desk, and we also offer OTC trading solutions to various sorts of institutions, asset managers, fintechs, and accredited investors seeking deep digital asset liquidity at the best price possible with ultra-high transparency.
Thank you. Morning, everyone. My name is Thomas. I lead sales globally at Flowdesk. We are a market-making firm looking at other lines of products, as you guys mentioned, OTC, custody, treasury management. We were one of the first market makers to be fully regulated out of France, where we are headquartered, and we've got the desk in Singapore and New York, and my background is TradFi as well.
Hi guys, I'm Fabio. I'm the founder of TokenOps, which is a tool to manage token investing and distributions for teams that are issuing their own token and for VCs to track their portfolio companies. And my background is in product and management consulting.
So before we start with the conversation from our guests and panelists, we'd like to sense a bit the room and understand how many of you in this room have ever had a conversation or have at any point in their life told to a market maker for whatever reason. We would like a raise of hand if you ever had to engage with market making for your daily life. Awesome. How many of you are actually a protocol with a token or have tokens that are traded in the market? Okay. So today we are here to give a bit of insights into a sector that is fundamental to this industry, but that is very behind the scenes during the normal operation. So retail users, which are normal traders, do not know that there is an entire ecosystem beyond this space. We would like to ask our panelists, what is for you the definition of a market maker, and when do market makers come into action in the cycle of a project or a token?
Sure. So the official statement is providing liquidity and charging a spread to be able to do so. I find the analogy of a grocery store quite useful for those that aren't familiar with trading, i.e. I think of a marketplace like Coinbase or Binance as a grocery store, and market makers as the people who bring the inventory to the grocery store. So without market makers, the shelves are going to stay empty. There's going to be no bread for people to come in and buy. And so the role that we play is to make sure that the shelves are always full of inventory so that when people come to the marketplace, they can actually transact. In terms of when we interact with projects and why, Crypto is quite unique versus other asset classes in that the price discovery mechanisms and go-to-market is quite unique. And so often we work with projects before they come to market to make sure that when they do initially, those shelves are full so that you don't come to market, trading opens, and there's nothing there and people can't buy or sell it. So in terms of when is a good time to engage with a market maker, I think generally as early as possible, especially for us, we've been in the space for about 10 years, so we can help with things that are outside of just the liquidity provisioning aspect. But it takes some time to think through what your strategy might be, and everything ends up sort of happening at the same time quite quickly. So starting the conversation as quickly as possible with the market maker to make sure that launch and go-to-market happens smoothly is definitely important.
Thank you, Gaia. Maybe I can add a bit more to the initial definition you provided. Market making, you make markets, so you make sure indeed that there's sufficient liquidity for anyone to come in to buy or sell a specific assets. And to add to your point, I would say with a minimal price impact. You want to make sure that there is no undue price action whenever someone wants to trade in a sizable fashion. In regards to the timing, there is a lot of expectations that it's crucial to have a market maker when you launch a token, and it is. But I think it's crucial over any stage you're in. Right now, we're dealing with various projects at different stages, and there is more than ever a huge need for liquidity. And I would add that obviously, maybe we can talk about it more specifically, but that's a business we need to run in a consistent fashion with no downtime and so on to ensure efficient markets at all times, day and night, 24/7 and 365 days a week, which is much different from TradFi.
Yeah, so I think both definitions on liquidity and the analogy of market making to grocery stores are spot on. So there isn't much to add there. However, I will just stress the importance of liquidity and state that liquidity is in fact the building block of all markets for all kinds of assets. And when it comes specifically to token markets and token issuers, it is really, really highly important to start and work with the market maker as early as possible, even before launching your actual market, in order to ensure that you have a liquid, adaptable, and efficient market that can attract investors of a larger scale coming in with larger trade sizes, and also more sophisticated traders that may be coming with algorithms, etc., that need those tight spreads to be in place in the market.
At which point then, so we are discussing that having a conversation with a market maker as soon as possible seems to be a suggestion that is unanimous. I would like Fabio to add a bit more details on when do you think during the phase of a tokenomics execution there is actually at the right timing where tokens are available in the market and should be potentially handed over to the various liquidity managers.
So we strongly encourage teams to engage with market makers very early, even in the phase in which they're designing their own tokenomics and they're modeling with the Monte Carlo simulation or whatever economic models they're trying to simulate their token economies, to get in touch with them because they have plenty of expertise. They've seen successes and failures, so definitely as early as possible. Then when it comes to handing over the liquidity, that's a bit dependent on when the unlocks are happening, if you have large cliffs, big jumps in circulating supply, for which as teams you may need more support to make sure that your price, the price of the token doesn't dump, and so you can coordinate with one or even more market makers to make sure that your project is a success, especially in volatile markets and markets with less liquidity, like what's happening right now in the crypto winter.
As a decentralized exchange, I can also add the point that there's definitely different stages where a market maker is needed. Tokens can live and can trade and survive by only having liquidity on chain. There's there are curves like the x times y equals k popularized by Uniswap V2 that support indeed the native market making from market participants on chain, but then there is also a time where due to necessities of liquidity managed most often on centralized exchanges, then you need to start having a conversation. It's not a must to have a market maker when you are starting a token, if your plan is to roll out a token on-chain directly, but then there is a stage when it's actually needed for specific reasons. Could we get some highlights on when, or of why this is actually a necessity when you want to work with a centralized exchange to interact with the market maker?
Yeah, so on centralized exchanges, usually the trading structure, the venue structure that we find is that of a central limit order book model, in contrast to automated market makers that exist behind DEXs and underpinning liquidity pools. And when it comes to the central limit order book structure, in order to make the market, there needs to be an active participant positioning limit orders across the order book's depth. And these limit orders need to be readjusted constantly, and the spread as well needs to be managed with the best bid and best ask constantly, in contrast to the format in which liquid provision occurs on-chain. Through AMMs, where everything is automated. There are, of course, efficiencies when it comes to on-chain trading, especially in the settlement, and as there is a lot of risk that is mitigated and even erased in terms of the counterparty risk that you find. However, the pricing still, when it comes to DEXs and on-chain trading, isn't as efficient as it is in SEXs, which is why still, even if there has been an increase in on-chain volume, the domination of volume occurs on central limit order books hosted centrally.
Yeah, fully agree with that. I think to add on the centralized exchanges point, again, back to the core business and value add of market making, you want to have consistent liquidity at any second of the day or night. Even when you are on a top 1, top 5 exchange, whatever the rank is, there will be, depth requirement that you need to meet at all times. So, in that sense, the market maker will make sure that, you meet all of these KPIs. And to add a bit broader, what I think it demonstrates is the role of a market maker is much more than just placing bid and ask orders. We all do much more than that. Whether we come in and discuss, tokenomics early, look at, connections, introductions, advisory, treasury management, or so on. I think the role is much wider. Maybe we can talk about it later.
So one issue that projects with a token usually meet, and this happens on different degrees, is fragmentation of liquidity, which is a very complex issue to address in a world where multi-chain tokens that have liquidity on various blockchains now. There are many protocols that offer to bridge tokens on different blockchains like Layer 0 or Chainlink CCIP or Connext, many more and beyond. Many are also here, so the conversations can happen at any time. But when you have fragmentation on liquidity on-chain, and then there are also market dynamics on an exchange, what happens when, for example, there is a volatility event on one of the two platforms, which could be on-chain or could be on a centralized exchange? And what's the role of a market maker to make these markets perfect so that there is balance of price across the two different platforms?
Yeah, so I think, as you said, fragmentation of liquidity is definitely like somewhat of an issue in crypto. We have lots of different chains. On each chain, we have lots of different venues, and there's still. And the reason there's so much is that I don't think we've come to consensus on where we want to trade as an industry and what the optimal designs are. And we'll talk more about those in a little bit. I think in the meantime, one of the key roles is arbitraging price differences on the different venues to make sure that price remains more or less equal on the different venues, whether it's on-chain or off-chain, so that, and I think this is something to think about as a project. How do I make sure that my users have more or less an equivalent experience on the different venues that they want to trade on, so that I increase access? Because you'll have some people that are perfectly happy trading on centralized venues and others that much prefer DEXs. So I think there's a big role to play there in making sure that price is maintained across all those venues from a market maker, and we definitely participate in that.
Gaia mentioned a word which is very important, actually, arbitrage. So who here knows what an arbitrageur is? Oh, okay, that's a good panel then. Can we add just a bit more color on the role of arbitrageurs on the different markets, just expanding a bit on the topic?
Yeah, so I would approach it from a different perspective, from the perspective of liquidity fragmentation and how it's managed from exchanges, and then the type of arbitrage or market making strategy that market makers employ to port liquidity from one venue to the other. So broadly speaking, liquidity in general is a chicken and egg problem, right? There is the market maker that is seeking for taker volumes, and the taker that wants to trade is seeking for liquidity deployed by the market maker. So first of all, when a new trading venue launches that may have listed tokens that a market maker is trading on a token-based market making model, or more broadly, larger pairs. One of the things that they do is that they incentivize the market makers to come in and add liquidity to the order books with various sorts of incentives, from rebates to cheap credit lines, etc. This, to start with, makes the trading more profitable for the market maker, and it shapes a trade that makes sense. Then the type of trading strategy that the market maker can employ is one of liquidity mirroring, which in a sense is an arbitrage where the market maker positions limit orders on one venue, and once he gets hit on that venue that he's making the markets on, he executes the trade on another venue with a taker order. In essence, what this does is this ports liquidity from the more liquid venue to the less liquid venue, which is where you're incentivized to trade on. And it is a trade that occurs in a delta neutral manner, which by definition is an arbitrage trade, where you are not taking any kind of directional exposure on the transaction. I don't know.
Yeah, and maybe just to add a point. I think what we are highlighting as well is the complexity of the markets. We're seeing new centralized exchanges coming in, new DEXs, V2, V3 likes, order book based DEXs, and I think what this highlights for projects dealing with a market maker is a strong focus on tech. Tech and connectivity is to me the name of the game right now, because what you described. Is very complex. It's very complex to do in an automated fashion with low latency at scale. We're talking being able to trade on simultaneous venues. We're looking at wallet connectivity. I mean, there's a lot of things happening behind the scene. So more than ever, I think it puts back the focus on tech and connectivity, and for crypto savvy people. I mean, it's amazing what's happening.
Yeah, you also mentioned V3 style, and indeed, when we Trader Joe built the next iteration of our DEX from what was a full range curve to a concentrated liquidity protocol, so the Trader Joe liquidity book, so-called. Basically, we focus on allowing everyone, which is a smart trader, or rather, smart liquidity providers, to be their own market makers. We have our own community of hobbyist market makers that are just liquidity providers on chain managing daily or weekly or at the frequency that they want liquidity on chain through the different methodologies that could be applied, so moving liquidity, creating liquidity curves. And the beauty of doing it on-chain is that anyone can be their own market maker, and fostering this little community that actually, if you look at liquidity on-chain, we are talking anyway about a big portion of liquidity today. It's very lovely that anyone can be their own market makers if they study how to deploy liquidity on a protocol that allows to do it in an easy and simple way. And the objective in this case for the hobbyist market maker liquidity providers is to earn fees out of their liquidity and providing it in the range that they feel is appropriate. One of the topic of on-chain liquidity and the stage of a token is also, however, the vesting. There is you hear a lot about it being something that needs to be addressed when new liquidity is unlocked. What do you do with it? Do you do liquidity providing on chain, or do you provide it indeed in a liquidity pool? Do you hand it over to a market maker for whichever purpose? Could we get more insights into what are suggested ways to handle token unlock and vesting?
As I was briefly mentioning before, I think there's been quite some research done, I think, in the space recently, especially by Six-Man Ventures and Outlier Ventures, who have analyzed over 50 protocols and their unlocking schedules over time. So I think there is basically three main learnings, which are there is much higher volatility during the vesting period, especially in the early cycle. So one of the suggestions there is to try to make the tokens vest, or the majority of the token supply vest, as soon as possible, because by just providing naturally more liquidity to the market, this decreases volatility naturally. So the question whether to hand over liquidity to a market maker or to liquidity pools sometimes just gets solved by itself. Then the other two big learnings are try to basically make small jumps in token circulating supply. So try to have unlocks that are less than 1%. Actually, there is evidence that if less than 1% token circulating supply is unlocked at any point in time, there is actually very minimal price impact correlation. And then the last point, I would say, make sure that basically your community is engaged, that you still provide transparency about what your unlocks are, and don't shy away. This is going to be a bit unpopular maybe, but don't shy away from engaging your institutional investors, and make sure that if large trades are to happen, that they're properly coordinated, even OTC, to avoid big price dumps on the public markets.
Yeah, and maybe I can add on to that from the trading side of that. I think that's something we work with projects on a lot through our OTC desk. So you have the market maker that's constantly providing liquidity to the market, but then you have an OTC desk that helps facilitate execution of some of these larger trades. So when you have a big unlock that comes up, whether it's the foundation that wants to liquidate assets, investors or founders, it's important to do that in a sensible way. And have execution that minimizes the impact that you have in the market. And that's something that we work a lot with the founders of our projects to ensure that you get access to the liquidity that you need without negatively impacting your project and your market.
Yeah, it's funny that the average crypto Twitter follower usually just reads this type of interaction as, oh, a wallet send a huge amount of tokens to another wallet, and then after some longer research, it can be identified that it was a market maker wallet that received an allocation. The transparency of this sector is definitely something that is can be improved, I would say, or as there is a lot of contracts also behind the scenes of how things are handled that normally due to try to create an healthy ecosystem are not fully understood by the average user. So I would like to ask you all if you have any more insights into what these efforts you are all putting into bringing more light into the daily actions of your roles and your companies to bring transparency to the sector.
Yeah, for sure, transparency is something crucial in the market, and especially when it comes to market makers, reputation is one of the most important things of the business. If you don't have a good reputation, you don't have any business. So in order to ensure higher levels of transparency between us as a market maker and the projects that we are working for, a couple of things can be done. One of the things that we do, and most market makers, I imagine, do as well, is offer daily, weekly, or monthly quantitative reporting. First of all, giving insights into the broader situation of their token markets, but even more importantly, giving very specific insights into the performance of the market maker and what is being done to meet certain best practices and certain standards. In addition to that, depending on the model of market making which is used, which is something that we could expand on a bit later, either we leverage our clients' accounts and the client deposits the liquidity in their own accounts, we integrate with those accounts, and we do not have any withdrawal permissions to add an additional level of safety. And in that way, both the client always has the and custody of the funds, but also full transparency into what is going on in those accounts. Or in some cases where we are using our own accounts, we can give read-only access, API access to the clients to be able to see what we are doing with that liquidity. Even more importantly, we do give as a best practice certain guarantees in terms of the average spread that is to be maintained in the market on a 24-hour basis, the average liquidity and the minimum liquidity that we are going to be positioning in the order books around the mid-price. And all those we ensure, and by being transparent on what we're actually doing, the client can be assured that we are meeting our requirements and we are doing the best efforts in order to maintain an efficient marketplace overall.
Fully agree. I mean, transparency, I think, is the name of the game, like regulation is. Similar to you guys, our clients want reporting. They want to know exactly what's happening at any second of the day or night. So, typically, our clients have access to live dashboards, understanding exactly what's happening in the market, knowing the market share we have, looking at, really liquidity and avoiding any myths around that. It's particularly important, we're setting up, I think, the same standards that you see in banking and with conflict of interest policies and so on. Particularly important as well on the OTC side, as Gaia was mentioning. You need, best execution formats, and you need to demonstrate that you can generate reporting. And, it's back to the tech approach. You need to be able to aggregate data from multiple sources, including DEXs. On-chain, obviously, it's more transparent, but you need to be able to demonstrate that, you're doing the right thing with data.
Compared to 1 year ago, or let's say the last cycle, so talking about the many things that have happened in the market in the past years, for sure have changed how business is done around many aspects of both market making and tokenomics. Which changes or evolutions have you seen happening in the market, and how are projects adapting to today's market conditions?
I'll catch this one and also add something to the question before. So I think transparency is actually something that I think teams care about much more now, and I think a lot of teams are much more cautious about launching tokens when they're not needed. So while a couple of years ago we were seeing tokens launch left and right, like every week there would be like 10 tokens released in the market. Now we see our customers like holding back for the market to come back, but also they're holding back to have the right traction in order to launch a token that has a meaning in their ecosystem. And within these, we see transparency becoming more and more important, which is why, like in our product, something we don't have yet, that we're building, is giving the possibility to founders to share outside what are the vesting schedules and unlock that they have programmed for the various actors in the ecosystem. I think there is still a bit of resistance from VCs and institutional investors on giving such transparency to communities, but we've also seen in like the YDX and some other like cases that the lack of transparency actually negatively impacts the perception from the communities about the quality of the project and the quality of the founding team behind. So I think, yeah, going forward, I think transparency is actually the answer.
Yeah, and maybe to add, I mean, I think the market has, the rate of change in the crypto space is extremely high. Things change very, very quickly, and over time, things are changing for the better. I think the industry in general is getting a lot more professional. The expectations that people have are increasing, and the types of players that are coming to the market is also changing. I think on the transparency point, 100% we need more transparency, but I think it doesn't go far enough because you can have access to a ton of information. At the end of the day, if you don't know how to digest it, it's only so useful. I think regulation is part of a piece of the industry that in crypto sometimes gets talked about as a dirty word, but it's super important for certain people because, while some things are important to be transparent, others are IP, and so you're not going to be sharing your IP publicly, but there needs to be a way for somebody to check that, you're doing things by the book, and that you're acting in the best interest of the community in general. So I think we're seeing the industry in general move much more in that direction. Exchanges as well. In some cases, exchanges are responsible for some questionable things, right? And so we're seeing also the quality of exchanges change over time. And, while volumes in general are low, so we're not seeing that change as much from a volumes perspective, definitely the expectation is that we're going to continue to move in that direction as the industry grows.
Yeah, so I want to point out that indeed I agree 100% with Gaia that the direction in which the market is moving towards is great. However, I will point out that where we are today, unfortunately, we are not at the most efficient market that we have been or that we will be going into the future. And this is why I think it is fair to say that in general, in the last year, for example, in the last 2 years, I think it's fair to say that retail interest in trading crypto assets specifically has fallen. And so the volumes coming from retailers have fallen. This is why we believe that the market has actually currently become a lot more player versus player, in the sense that it's the same institutions pretty much trading against each other currently. And what happens is that when there are big institutions and big traders that trade larger sizes in the market, they tend to go more OTC. And you have the dealers behind those OTC desks that are executing and hedging this flow back on the order books of centralized exchanges against other market makers. So the result of all of this is that there is a lot of build-up of toxic flow around the mid-price, and market makers are put in a position where they have to either remove liquidity or at least start quoting wider spreads in order to avoid this toxic flow. So where we are today, we are in a stage where liquidity has exited the market, retail volume has exited the market as well, and spreads have widened. However, I do believe that we are seeing a lot more institutional interest, and leading into the next bull market, and through the next bull market, we will come back at a stage and even better than we were before in terms of liquidity and spreads.
To go back to on-chain activities, there is a trend that lately is being used via few protocol that is RFQ. It's a term that is not much heard or understood, but is actually applied by a few decentralized exchanges to offer liquidity on chain where they do not have liquidity pools that are available. Other type of activities that decentralized exchanges apply are on-chain limit orders, which not many protocols have managed to release as the lack of liquidity on the other side of the limit order could mean that an order on chain is not filled. And there are a few complexities of, for example, the lack of many decentralized exchanges offering a model that is different than the AMM model, as clubs or central limit order book type of on-chain exchanges are very rare, and they have a problem of finding liquidity for on-chain limit orders and actually spot trading. Could you tell us a bit what's happening there and what are solutions applied in this case?
Yeah, maybe I can start commenting on that. As you mentioned, it's part of all of the developments we're seeing on chain. I think typically you see two types of RFQ approaches. Maybe the traditional that we touched based upon earlier, where the market maker is taking a principal approach. Similar to banking, you've got a dealer broker stepping in, dealing risk transfers. You're quoting a firm price and you're done at a price. You're hedging your market risk somewhere else. And on chain, I think the trend you're seeing as well is this type of RFQ model where effectively in the backend you're going to be streaming an order book, which can be pretty relevant for most market makers, obviously. And again, not to sound like a broken record, but it's back to the tech play. To be able to do that, you need to be able to stream that continuously. And again, you need to have access to hedge that somewhere else. But I think it's a very interesting development because you're taking it away from maybe the less transparent model, the principal approach, where you don't really know what's happening, to something much more transparent, where effectively you're bridging what we know from traditional order books and you're mixing it with a traditional RFQ model. So I think it's quite interesting.
So RFQ request for quotation, but many could call it differently. Let's try to explain when this happened, and then I'd like to get as clear as possible explanation of what happens in the back. A trader could go on a decentralized exchange or an aggregator on chain, submitting an order to get filled at a certain value, and their perception will be the liquidity is happening out from us liquidity from some liquidity on chain, but the order is not filled immediately. These orders usually have an expire, so you set the buy order of buying X tokens with Y amount of tokens. You wait, at a certain point you get filled, maybe not, potentially yes. What is happening truly when this type of trades are happening on chain?
Yeah, so I mean, depending on the protocol, they're designed very somewhat differently, but I think the high level idea, without getting too technical, is just that you come in, you express interest to do a particular trade, and on the back end, a liquidity provider can either say, okay, I'm able to fill that trade at that price or better, or I'm not, and you move on. How that gets done technically really varies, and probably we'd be here for a long time talking about that. But I think essentially that's a really interesting evolution for the DeFi space, because I think what AMM solved was a centralization problem. So you move away from having an order book where the data is owned by a central entity or managed by a central entity, to a place where you simply add capital and an equation, a ratio essentially decides what the price is going to be and automatically does that for you. In the RFQ model, you have to have active participants that are constantly watching out for the requests that are coming in and deciding to respond or not. It's a much more efficient process, and I think, again, this is something that's not super widely understood in the crypto space, but from a capital efficiency perspective, i.e. how many dollars do I need to have access to trade $1,000 worth of something without moving the price? on an AMM, it is very, very inefficient and very expensive. So the evolution and moving towards this RFQ model where someone is not passively allocating liquidity somewhere, but only engaging with it if needed and if useful, means that as a whole, potentially, it will help move us away from this liquidity fragmentation issue and help with the costs in general of the industry from a trading perspective coming down. So we're super excited about this evolution, whether it's Uniswap X, CalSwap, there's lots of different protocols looking to move in this direction. There's lots more work to do, but I think, again, speaking of the institutionalization of the space, it really shows the level of sophistication and understanding that people are finally getting. So I think before, a lot of people were passively adding liquidity to pools, getting some tokens, being happy, and not realizing maybe that they were incurring things like impermanent loss. So as people start to track the profitability of their capital allocation, these types of solutions are essential.
As we are talking about so many services that are offered and there are many type of business models that are applied behind liquidity on-chain or off-chain. As we mentioned, a liquidity provider on-chain provides liquidity because they earn fees out of every swap. What is, however, the business model of market makers, and where do fees or anyway revenues for a market maker come from?
Yeah, I guess this is where it becomes a little less sort of maybe straightforward to explain versus fees, but as I mentioned, basically we have internal models and engines that give us an idea of where we think fair value of a particular asset should be, and that's also based on where we can actually, at what price we can execute it on a variety of different venues. So the more you're connected to, the more you know, the more data points you have to decide what you think something should be worth, and you manage the liquidity that you show accordingly. And if you can show you charge a spread basically to say, okay, I'm willing to buy at this price, I'm willing to sell at this price, and you make the difference between those things. Obviously, people need to actually trade with you to be able to capture that spread, and here that's where we compete with other market makers. So you have to be tight enough that you can capture the spread, but not so wide that you're losing money in competing for that. So it's not quite as simple as I trade, the user pays a fee, and I get paid that fee. It's a little bit more esoteric than that. And so a mix of arbitraging and capturing spreads is really how we make money and keep the lights on and pay our employees and everything.
Yeah, thanks, Gaia. So there are various models indeed. One of the models where we've seen lots of demand and lots of traction is, I guess, the service model, which is, I guess, a different approach than the one you described, where essentially, we are acting as almost as a service provider. We are paid a service charge, and the project is almost renting our trading capabilities, our infrastructure. So it's very much, externalizing the trading mandate, whether you're an exchange or a project.
Yeah, so maybe I can make a summary of all types of models, since at Hercle we pretty much run various sorts of strategies. So there is proprietary trading and market making that can fall under it, which most usually you don't face any kind of client. It's you and your own funds. There can be single pair market making, multi-pair cross-exchange market making, a whole bunch of different market making strategies where at the core how you make money is by making and capturing the spread, as Gaia mentioned. Then there is token market making, which is, I guess, what you folks are also more interested in, where usually we have two main models. There is the service fee model or the retainer fee model, where the client, which is the token issuer, provides usually both base and quote currency as a liquidity for the market making to be done. And the market maker is compensated by a fixed monthly, quarterly, whatever it is, fee by the token issuer, by the client. So the main profit stream of the market maker is out of the fixed retainer fee, and then maybe the trading profit can be shared with the client or not shared. It really depends on the market maker. The other model, which is the one I believe that GSR is more active in as well, is the loan-based model, where the token issuer, in fact, only needs to supply base currency, which is the token that they have issued, to the market maker in the form of a loan. The market maker then provides his own quote currency, so his own USDT, USDC, whatever it is, to make the markets. And the way that the market maker then repays that loan is by exercising a call option that is underwritten at the time that the loan is made. In this model, the token issuer doesn't face any kind of fixed cost to the market maker, and the way that the market maker profits is based on the volatility of the underlying asset. So there is the spread that is made, there is gamma scalping strategies that are enforced, and there is also, of course, the differential between the strike price and the current price of when the option is exercised.
Yeah, maybe to add a little color on that. So this is definitely the model that's used when it comes to a project hiring a market maker to make markets on their for their token on an exchange. And I think, you know, the key thing there, as you mentioned, when it comes to bringing capital is, I think the real difference that we make there is when you need to deploy hundreds of $1,000s worth of liquidity on some of the large exchanges. It's, you know, sometimes projects don't have access to that. So it's super useful to have somebody who's able to do that and make sure that everything is constantly running, but also that is aligned in your incentives, in that as you grow as your project, you know, the market maker is naturally incentivized to take on more risk and add more liquidity, as opposed to, you know, basically being paid a fixed fee, in which case, you know, if you start to grow, you might have to renegotiate that fee. And so that's why I think there's merit in both cases. But that's why we ended up choosing to switch from the retainer-based model, you know, 3 or 4 years ago to this model. And we found that that works quite well in the name of sort of true partnership with the projects that we work with.
Perfect. We are getting close to the question and answers, not the end, because we have time for you all to ask the most interesting questions you have in mind. So mic opens very soon. I would like to ask if there is any further topic you'd like to touch before we go to the audience. Anything of interest that you think can be relevant after our conversation?
Too many things to talk about in 2 minutes.
All right. Are we ready for some questions? Yes, nice. All right. I'll bring the microphone and let's start.
Thank you. A couple of you mentioned toxic order flow and how you respond by widening your spread. Would you mind elaborating a little bit on informed traders, how you detect, quantify, and respond to informed traders?
Did you say informed traders?
Yes.
I mean, I think it's, you know, I don't necessarily think that is the key thing. I think more is if you have, you know, abnormally large activity on one or the other side. So if you have a huge amount of demand or supply coming into the market at one time, I think that's, you know, one of the key things here. And I think, like the simple answer is trying to be smarter. So, you know, developing algorithms that track these types of instances faster than them coming to the market, and moving quite quickly to adjust the price and the spread accordingly so that you don't end up on the wrong side of it. Maybe you guys want to...
Yeah, so I think Gaia pretty much touched upon it, but as it has already been discussed, it is very important when you're a market maker to collect data. You collect data on the exchange on which you're trading on, you collect data even on trading venues that maybe you're not currently trading on. With all of this data collection and data analysis that happens on the back, which is very active, I would say, and we have data analysts and data scientists as well that always overlook it, you shape certain patterns that you see in certain markets, and based on those patterns and maybe shifts and deviations away from the standards that the models are being fed, you shape the strategy actively according to what is going on. So it is really important to have, first of all, really smart and adaptive algorithms, but I would say it's even more important to have the smart traders and the smart quants that are behind to actively manage those algorithms and adapt them.
Yeah, and I think just to add, I think it's all about the communication with your market maker, typically. So, in the service model we have, because typically, as you were describing, we tend to work a lot with clients' capital. They do have a lot of information as well as to, what's happening from the community sometimes or so on, and it comes to the ability of, understanding that, skewing the books when it's necessary, shifting the distribution. So it's really an algo capacity and the ability to trade on multiple venues and to be very nimble about the capital allocation, I would say.
As a market participant, I think there are many traders or investors that with time will feel more and more attracted from what you're doing, market making. It's a rabbit hole. And it feels very academic, very formal, and it has a different flavor of compared to other strategies. It's kind of sort of deep arbitrage inside the order book. So, without having capital, which of course is one of the requirements to get in your market, your kind of activity, your business, what interested investor or trader with maybe quantitative skills or willing to acquire quantitative skills, what can he do to approach the topic and get skilled, and what is the skill level minimum necessary? How do you access this kind of operation? You can do it yourself. I've seen it in the recent history, a lot of players growing. Of course, it has been very central for the market. What you do, it's understandable. But how somebody that feels attracted gets into the actual, what would you suggest for somebody to access, to give access and transparently look into it? And of course, which is, I understand is a technology which also has costs, as capital costs, technology costs, and in the traditional markets is something that has grown, and that in crypto, of course, we don't want the same thing to happen in a way, so it's kind of a counter to what the ethos of the crypto markets are, want it to be, but of course it's inevitable. So the inefficiencies, of course, are everywhere. So how can we access and understand, have a better understand, formally access and try to play the market maker game as, newbies, let's say?
Yeah, for sure. So first of all, to address, I think I'll start by addressing the point of the capital requirements that are in place to be a market maker. It is at a very competitive level, of course. So it is true that there are pretty large capital requirements. However, something that is a misconception is that in crypto markets, when you do market making and HFT, you face the same costs as in traditional markets. In traditional markets, part of the largest expenditure, in my opinion, other than the overhead that you have in employees, does come with the technology infrastructure, because the trading venues and the order books are physically hosted. So a market maker, as they usually compete on speed, so they need to be as trading with technology that is of the lowest latency possible, need to host their own computers next to the exchange's servers, which comes with a big price tag. They need to have very advanced algorithms that are written to the lowest level of the machine, etc., etc. This thing, in the crypto markets, although there are some introductions of new ECNs, for example, that are physically hosted, we don't really have. Most exchanges are cloud-based. So there is not that tight and heavy capital requirement in terms of infrastructure. Now, what you still need to be very fast. Your algorithms need to be, again, of the lowest runtimes possible, and you also always need to be finding a new edge in terms of the strategies that you employ. How do you find a new edge? So what skills do you need to shape? For sure, quantitative finance comes in place, mathematics and computer science. A combination of these three can produce a strong market maker. It can be done on the individual level, but to be highly competitive in the market where there are big firms that are doing it, big teams are usually needed of multiple quantitative analysts, multiple algo traders, and multiple pure developers as well. However, if you want to start and learn how to do market making at the simplest level, which can be a form of grid trading, you can look into it, and you can do it without having a high capital constraint to start forming algorithms on how to position limit orders and run certain strategies. I don't know if it covers it. Maybe there's something to add, or.
No, nothing in particular to add. On the ethos maybe point, I would say definitely, you know, the goal, I mean, there's three of us here, there's an even longer list of other market makers. There's definitely a lot of participants that have set up to do this, and I think that's a sign of a healthy market, and I think the more there is, you know, the better. At some point when that list becomes too long, the market's so efficient that people can't profitably do it, so the list will shrink. But, you know, I think the more we have, the better in terms of, you know, keeping constant liquidity in the market and making sure that we're all competing. So, I mean, definitely, if you want to get into it, I would say it's an exciting endeavor and crucial for the functioning of crypto and the protocols that are being built in the space.
Hi. You guys talked about liquidity fragmentation earlier. And I feel that's a fascinating issue to tackle, right? And I'd like to talk about the elephant in the room, which is bridges, right? So bridges are essentially stablecoin issuers as they issue currency on chain that can be redeemed both ways, one-to-one, right? So they're stablecoin issuers, but they're not held accountable and to the same standards that stablecoin issuers are. And as we see, they periodically get hacked. So I guess for you guys, this must be a huge issue, right? And so my question is, how would a market maker take on the issue of the centralized attack vectors taking on bridges, right? So how would you take on the issue of bridges being a huge target for exploitation, right? I guess that's my question.
I think solution number one is to not use things that you don't trust. So doing a ton of technical DD on the things that you do end up using. We, you know, don't tend to have tons of capital locked up in bridges. And so the second element of that is a lot of people, much like in the DEX world, are building new iterations of these bridges and trying to basically tackle that problem. Like, obviously, having capital locked up in random pools is not an efficient way of doing this. How can we solve that? And there are lots of teams that are working on that and coming up with interesting solutions. So, you know, another way that we tackle it is, you know, we have a VC arm, we invest in projects, supporting those teams as they, you know, spend their time and energy trying to solve that problem, and trying to support them also in being alpha users to identify what some of those issues might be. Yeah.
All right, we are done with the panel. I know that there were some people wanting to ask some questions, so I'd like to ask if you can reach out to them directly on the side, outside. We are going to move on without a break directly now with the next speech. So thank you very much for listening. Thank you to our guest for coming here. Thank you for coming to ETHMilan.